Okay, so recently there's been a lot of talk about the US government running out of money. What does this mean, and why is it important? When government spending exceeds tax revenue, the government can issue bonds, which are essentially shares on its debt, to buff up its coffers. This is attractive to buyers because, unlike most issuers of debt, the US government has never defaulted, so it's a very sure source of revenue, particularly when the economy is looking iffy. But there are consequences. Each new bond represents the price of the bond issued plus the cost of the interest. Like a bank loan, the government is essentially selling money now at the cost of even more spending later. This can stack up, and governments that let their national debt stack up can be crippled by the interest payments. If this gets bad enough, entities might stop buying government bonds altogether, meaning that the government in question will have to look to central banks or the IMF to bail them out. For the US, this isn't an issue because the Federal Reserve will always purchase US debt. But when it does, it signals to markets that it's willing to create massive amounts of money to essentially print away the national debt, and that leads to inflation. So we're now deep into a continuous cycle of quantitative tightening, with the latest contributor being the Bank of England. Yet, inflation persists. This is normal. Inflationary pressure is being driven by geopolitical factors, and central banks have absolutely no way of controlling this. But quantitative tightening has an impact on other things. On the one hand, it reduces consumption in sectors like tech, which is why we're seeing so many layoffs there. But on the other, it also reduces the liquidity supply of banks, resulting in instability for them. Currently, we seem to be trying to have it both ways, provoking a recession through quantitative tightening's impact on unemployment and consumer spending, but preventing bank failure via collective assurances and bailouts. This is a train to nowhere. It won't resolve inflation because 1, it's geopolitical, and 2, bank bailouts are quantitative easing. It's just quantitative easing for entities that will end up sitting on the money because remember, banks tighten up lending when interest rates are high. So where could this take us? A desiccated tech sector, lower stock market returns, household spending down and unemployment up, yet inflation roaring onward as the economy slows. Stagflation. This mix of central bank-driven quantitative tightening and government-driven quantitative easing is something historically new, something that has interesting implications for how we understand economics on the whole. On the one hand, government action and its impact on debt suggests that we're moving back towards an uncontroversially Keynesian model of spending. On the other, central bank policy is straight out of the 1980s, with the desire to tamp down on excess spending. While there's certainly a rationale for both of these movements, what we actually need is to have a broader conversation about how we as a society want to handle debt, both public and private, then formulate a plan and implement it, instead of playing tug of war with the money supply, because the people who will suffer most from this will be ordinary households. Subscribe for more on geopolitics, markets, and technology.